So, right, again, this is how we're able to see these signals because we have better uniform accounting data that can actually point us in the right direction of one, what are the big trends that we're seeing? And then what companies are we unlocking? So, of course, the obvious question might be, so how do we play this Capex super cycle right now? Well, the first thing that we need to do to be able to play this Capex super cycle is we need to make sure that the environment in the market right now actually sets it up to benefit from the headwinds and tailwinds that we're seeing going on. And to do that, we need to not just use a uniform accounting on individual companies. We need to take a step back and understand the macro, right? Because if we don't understand the macro in the market environment, we can't actually effectively know if that theme is going to work and which companies are going to win. And this is the real power of what uniform accounting can do is we aren't just able to look at individual companies. We're able to look at the market as a whole. We're able to step back and understand where are we in a bull market or in a bear market because of the fact that we have a better understanding of where the credit cycle is for companies and importantly, where the uniform earning cycle is for companies to understand are companies set up to be able to invest? And is the market set up to support those companies investing in a way that's going to lead to this Capex super cycle that we think is going to be transformational in terms of for the US economy and also for the market? Or is the market going to actually prevent that from happening? And this is where uniform accounting from a macro perspective becomes so important. Because what we can see is when we look at real corporate profitability, which is what this chart shows you. So this chart is for the whole entire US economy. And effectively for this chart, what we're showing is how profitable are US corporations. And you can see, just for cost of context, right, the hurdle that companies really probably need to exceed to be economically profitable right now is to have around a 5% return on assets. And if we look, what we can see is steadily the return on assets for companies have been improving the last 20 years. And right now, we are at all-time high profitability levels, right? That's actually great for investment cycles because that means companies have the money to be able to invest. And if companies have the money to be able to invest, they can set up to take advantage of the fact that if they do, there is massive demand for their products, as we could see with the supply chain issues that we have, as we can see with the investment opportunities in the investment cycle that we see coming on. And we know companies need to invest because what this chart shows us is, again, if we aggregate and look at the entire US market, it's the S&P 1500 right here, which is basically the entire US stock market, what we can see is assets are old. What this chart shows you is the net to gross PP&E ratio for companies. The PP&E, right, all that means is factories, computers, cars, everything that you can think of office spaces that companies need to be able to run their businesses, all the fixed assets. How old are they? Right, effectively, the more depreciated they are, the smaller the net PP&E is relative to growth. Right, the lower this line gets, the older assets are. And older assets, right, break down more, causing more delays in supply chains, causing more issue in terms of expanding capacity if you have booming demand. Right now, we have booming demand. And so what the issue is through the pandemic, companies have starved themselves of CapEx. They have massively underinvested, right? We can see this drop down, right? And so what we think is happening right now is because of the booming demand we're seeing and the understanding now, as we saw from Intel, from Generac, from GM, from Ford, and that's just a handful of the dozens upon dozens upon dozens of companies that have announced that they're spending CapEx, as they all understand we need to correct this. For context, the difference between here and here is $500 billion plus in CapEx investment, which is going to go to very specific parts of the economy, which is what we think is so interesting. And most importantly, the credit markets are still supportive for companies being able to borrow to finance that investment. What this chart shows you, I know aggregate CDS index with RFR sounds very cumbersome, but the easiest way to think about this is that what this chart shows you is for high yield companies, the riskiest companies, all the way to investment companies, investment grade companies, the safest companies in the world of credit and how Moody's, S&P, and Fitch rate them. All of them, the credit environment is still relatively healthy, right? If you look at for high yield debt, the riskiest debt, what does it cost for those companies to borrow money right now? It basically costs what it cost them from, right, call it 2014 to 2019 on average. Meaning, in the last bull market, we basically had the exact same credit structure we're at right now. We're nowhere near the high interest rates that we had back in 2007, 2008, 2009, 2010 that prevented people from investing. We're in a healthy environment for investing, and the same is true for investment grade. even after the Fed has raised rates and the market has reacted, right? We're in a healthy environment in terms of access to credit. And now many people might also ask, well, but hold on, I've heard things about, the 2-year and the 10-year basically leveling out, and that's always a sign for recession, or that, people are being starved of access to credit. Well, the reality is banks are also wide open in terms of making credit available right now too, because of this chart. What this chart shows you is what the difference is between the 3-month treasury and the 10-year treasury, right? Banks are effectively a spread business, right? They borrow short and they lend long. And so as long as there's a spread between the short-term rates and the long-term rates, right, banks will make money. And where banks borrow isn't in the 2-year. Banks borrow money at 3 months and sub 3-month increments. So what we can see is when the 3-month interest rate is way below the 10-year, banks are minting money. What we can see is right now we are at a great point for banks to make money, which is why banks are wide open and making credit widely available for everyone. So the credit markets are open, banks are making credit available, companies need to invest, companies have the profitability to be able to invest, and we have all of the macro tailwinds for companies to be set up to invest. And that is why we're pounding the table on what we like to call, right, the Capex Supercycle.